Hi, my name is Melissa, and I've been managing projects for over 10 years. I'd like to share with you some earned value management techniques that can be used on your project to help improve your overall project success. Earned value management, or EVM, is a project management methodology that uses the schedule and budget baseline to track project performance, as well as to forecast future performance. Earned value management, EVM, starts with three basic building blocks that will be used in all calculations. First is our planned value, or PV. This is the approved budget scheduled to be completed at a specific time. The total planned value for our project is known as the budget at completion, or BAC. Next is our earned value, or EV. This is the budget that's been earned at a specific time for the work that has been completed. Actual costs, or AC, that's as the name implies. It's the costs that have actually been incurred for the work that's been completed at a specific time. So now that you understand the three building blocks, let's take a look at an example. Let's say that you've created a budget for a project that has 3 team members working 40 hours per week, and that the project is expected to last for 10 weeks. You've created the following budget. Now let's take a look at the planned value. The total planned value, or the budget at completion, is $300,000. We got that by calculating 1,200 hours times a rate of $250. We can also see that for week 1, the planned value is $30,000. Next, we're going to take a look at the earned value, or EV. Let's say that today's the end of the week 3, and the project team has completed 25% of the project. We can calculate the earned value by taking our BAC of $300,000 and multiplying it times 25%. That means that we've actually earned $75,000 of the total project budget. Last, we're going to look at the actual cost. Now, actual cost usually comes from an outside source. You might obtain this by running a time report, or finance might give you that number. For this example, we're going to say that finance has provided us the numbers. For the 3 weeks, finance has told us that this project has cost $84,000. Now that we have our 3 EVM building blocks, we can start to do some variance analysis onto week 3. First, let's take a look at our cost and do some cost variance analysis. You can remember that we earned $75,000 for the work that's been completed, but finance told us that we've spent $84,000. That means that we have a cost variance of $9,000. This project is currently over budget. That's bad, but don't worry, it's not too bad. Because we detected it early, we can work with the team to determine a mitigation plan. We could be on track again next week. Next, let's look at the schedule variance. Remember, we planned to spend $90,000. We only earned $75,000, so that gives us a schedule variance of $15,000. This means that we're behind schedule. Not too surprising because of our cost variance. I think this team needs a plan. Now let's take a look at this visual representation for week 3. This is a view that can be used for your status reports or to provide an update to steering committee members. You can see here our blue line represents our budget at completion of $300,000. For week 3, we plan to be at $90,000. You can see here in the graph that the actuals are $84,000, slightly under our plan, but then the earned value in purple, that's $75,000. That's also under plan. So it's easy to see here with the graphical representation that this project is trending a little bit behind plan. Now let's jump ahead and take a look at a week 5 analysis. We'll start again with the cost variance. At week 5, we have an earned value of $165,000. Finance has told us that our actual costs are $144,000. That means we have a cost variance this week of $21,000. This means that we're currently under budget. That's good. Now let's take a look at our schedule variance. The planned spend for this week, or planned value, was $150,000. We earned $165,000. That gives us a schedule variance of $15,000. That means we're also ahead of schedule. Good job, team! So let's take a look at our project at a glance for week 5. We can still see that blue line across the top representing our budget of $300,000. We're about midway through the project now, and our earned value is $165,000. That's above the $150,000 that we planned to spend. Even better, it's above the $144,000 that we've actually spent. This means that this project is tracking ahead of schedule and ahead of budget. That's great. In addition to using EVM to track historical costs, we can also use it to forecast out what we believe project costs are going to be. The first calculation that I'd like to show you is an estimate to complete. This calculation takes a look to tell us how much of the budget is left for us to spend in future weeks. The calculation's pretty easy. We're going to take the budget at completion of $300,000, subtract it from our actual costs of $144,000. That's going to give us an estimate to complete of $156,000. Now, it's likely the question that you're going to get from project sponsors is, how much is this project going to cost me in the end? Well, we can use the estimate at completion, or EAC, to calculate that value. There's actually 3 different ways that you can calculate an estimate at completion. What I'm going to show you today is my preferred calculation. I like this calculation because it takes into account how you're trending to your cost performance as well as to your schedule performance. However, this calculation is a little bit more complicated, so I'd like to break it down into 6 steps. The first step, we're going to take our budget at completion and subtract our earned value. So we're going to take $300,000 minus $165,000 for a new value of $135,000. Now in steps 2 and 3, I'm going to show you some new calculations. Step 2 is going to be our Cost Performance Index, or CPI. This is calculated much the same as our cost variance, but instead of subtracting, we're going to divide. So we're going to take our earned value of $165,000 divided by our actual costs of $144,000 for a CPI of 1.146. Now that shows us that we're trending ahead or better than our planned budget. Step 3, we're going to calculate a Schedule Performance Index, or SPI. This is calculated much the same as the CPI, but instead of using actual costs, we're going to use the planned value. So for SPI, we're going to take our earned value of $165,000 divided by our planned value of $150,000 for an SPI of 1.10. Again, this is trending ahead of the planned schedule. In step 4, we're going to take our newly calculated CPI and multiply it by the SPI. So we're going to take 1.146 multiplied by 1.10 for a total of 1.260. Now in the 5th step, we're going to start to put some of these calculations together. The first thing we're going to do is take the $135,000 that we calculated in step 1 and divide it by our newly calculated CPI and SPI that we did in step 4. $135,000 divided by 1.26 is going to give us $107,107.44. The last step is to take the $107,000 that we just calculated and add it to the actual costs that have been spent on the project to date. That's $144,000. So now what we can estimate that is, if this project continues to perform as it has against the cost and schedule, this project is going to cost us $251,107 at completion. That is ahead of our $300,000 that we had originally budgeted. Well, that's it. It's pretty simple. I'd like to recap. Earned value management is a technique used to track a project's financial success. The 3 building blocks of EVM include planned value, actual cost, and earned value. These three building blocks are used in all of your EVM calculations. EVM can show your historical performance as well as forecast future project performance.